All right, Team Tackle, welcome out to Tackle Trading 101 presents Swing Trading 101 technical analysis for beginners. This is Coach Matt. We're gonna have a fun time here tonight as we learn a little bit about the basics of swing trading. I know a lot of people in our community have a tremendous amount of understanding of the technical condition, and sometimes we have a tendency to talk advanced, a little bit intermediate to advanced technical analysis in a lot of our programming. So I felt let's do a little bit of a beginner level basic webinar and understanding the beginner stuff when it comes to the art of swing trading out there. And as you come into the program here tonight, if you enjoy our education, we like to give at Tackle Trading. Make sure to give us a nice little like and share. By way of introduction to the people that do not know me in our community, my name is Matt Justice. I am a coach. I am a mentor, a trader, an investor, an entrepreneur. You can say my kids have a very curious time, very interesting describing what I do. I'm also the founder and the host of the Trading Justice podcast. But at the end of the day, I'm a father and a husband, and I am excited to be here with the community of tackle trading to introduce a topic that's very near and dear to my heart, something I love talking about, love teaching, love doing, everything about the art of swing trading. And we're going to get into it here in just one second. Before we do so, though, we on Black Friday, our tackle trading holiday sales kicked off. And if you're looking for educational needs, application needs, looking to be a part of an awesome trading community to give you all the education, the application content your heart desires, you can ask all of our pro members how much content we provide to our community. It's sometimes overwhelming, but you get to pick and choose the things that you like to consume the same way we do in every type of content out there in the world of the internet. And tackle trading, we're no different. We like putting on a lot of webinars. We like doing a lot of reports. We put out the tackle trading newsletter on a weekly basis. We do the halftime report. We do about 15 different webinars every single week into our pro member community. And if you are looking for a community, this is a great time to be a part of tackle trading. You can always get a 15-day free trial to join Tackle Trading Pro membership and test out everything we do, from weekly reports to traders lounges to coaches shows to cash flow clubs, you name it. You can always get a 15-day free trial, but this is an awesome time to think about 2024, ladies and gentlemen, and getting your educational needs dialed in right now so that you can make 2024 your best financial year ever. We plan on doing that at Tackle Trading, and we hope you're along with the ride for us as well. We've had a great 23, we had a great 22, and we're looking to have another great 24 as well. You can always go over there to Tackle Trading, hit the storefront. All of our products are on discount right now, from an annual membership to Trading Lab annual memberships to every premium system. Everything we do at Tackle Trading is on a discount right now. Great time to get all of your holiday needs. And if you ever need to talk to my girl Sylvia, Coach Sylvia is one of the best traders at tackle trading. She's also the individual that you can sit down with, schedule a 30-minute consultation, and talk about what your educational needs are. Have a one on one moment with Coach Sylvia, talking about what your needs are so that you can specifically tailor an educational plan for you so that you can accomplish your goals in 2024. And with that said, let's talk about the webinar here tonight. Swing trading is, and we'll talk about the definition and all of that, but swing trading is one of the most popular forms of trading in the marketplace. A lot of new traders will gravitate to swing trading because of the technical conversation. It is a highly technical conversation. Whereas when you're dealing with longer term analysis in the market, oftentimes we're dealing with fundamental analysis, behavioral analysis. How many times have we talked about where the economy is going to be in 2024, where interest rates are going to be, what monetary policy is going to do? All of those big picture macro conversations everybody has an opinion on, whether that's an informed opinion or a biased opinion, does not matter in our world any longer. Everybody has an opinion on it. That's fantastic. I love having opinions on those things too. I talk about those things all the time. But the simple reality as a technician, from a short term perspective, if you're in a trade for the next 5 days, I doubt you care what 2024 in May the central bank is going to do, or what the monetary environment in 2024 is. The only thing you care about is what the price action is going to be doing over the next few days. And that's what we're going to be focusing on, the art of swing trading, what it is. And again, I'm not going to get into the weeds here tonight. I'm not going to get into the nitty gritty details of every single application situation you can go through. We're going to focus on the fundamentals of swing trading here tonight. What about trend analysis? How do you identify trends? What patterns make up those trends? And then the vitally important conversation on being able to understand where support and resistance is. You always want to buy at support. You always want to sell at resistance. If you ever come across somebody out there that's like, hey, come join us, we'll tell you where to buy and sell everything. Well, okay, come join Tackle Trading. We'll teach you how to do that for yourself, because the only thing they're doing is identifying support and resistance. We'll teach you how to do that for yourself. And so what is swing trading? Swing trading is, by definition, short-term analysis. It is, you're in a trade 2 days to 2 weeks of time frames. I categorize it pivot to pivot. And I want everybody to write that down, because that is how I define swing trading. Oftentimes, other traders will define it as a certain amount of time period in the market, and I have no qualms about that. If you want to say it's an average of 7 days, thumbs up, good job. I have no problem with that. You want to say 2 days to 10 days, no problem. What I'm going to suggest is it's kind of the price action that determines the time frame, and so it's really pivot to pivot, but you are looking at holding a trade longer than 1 day and shorter than multiple pivots, which is typically around 2 weeks in the market. Less on average, but typically that's how you can kind of look about it. One of the greatest traders of all time, in fact, I would strongly recommend everybody look into this gentleman. His name is Jesse Livermore. We're going to give a few quotes out of Jesse Livermore because I find him to be one of the greatest traders of all time. He said this quote, "There's nothing new in Wall Street. There can't be, because speculation is as old as the hills. Whatever has happened in the stock market today has happened before, and it will happen again." I know oftentimes we're all a little bit of unique, precious little snowflakes that think everything is unique to the environment of 2023, that at no point in the history of mankind have we ever seen these types of situations, when the simple reality is that's not true. There is a rich history of all of these situations occurring in the past. And if you want to understand, for example, how a marketplace in the central bank has reacted to elevated increases in inflation, you can go back to the 1970s and early 1980s and study how the market functioned in those environments, and study how behavioral analysis functioned in those environments. Because even though technology has changed things, algorithms have changed things, many things have changed, but most of those things that have changed go to the volatility and the speed of the market. They don't go to the underlying reasons of why the market moves the way it does, or the behavioral analysis of why we as individuals make the decisions we do. We're no different, ladies and gentlemen. I know we're a little bit precious in 2023, but we're really not different from a human nature perspective from the 1950s to the 1970s to the 2020s. And so speculation, yeah, it is as old as the hills. It's been around for absolutely ever, and there's not really a unique environment in the market. It has happened before, and it will certainly happen again. And that's one of the driving principles of swing traders, is the reliance on history repeating itself. And even though the volatility might be different, the simple direction of something usually is fairly consistent. And so once again, I'll just read this for definitional purposes. Swing trading refers to a speculative short-term type of trading that attempts to capture gains in the financial instruments, usually short-term instruments. You're talking stock, short-term option. I don't want to say futures is not a great swing trading environment. It can be a really good swing trading environment. Futures are, in my estimation, a better day trading environment. Options, stock, currencies, all of it can be a tradable instrument. Some tradable instruments are a little bit better for swing traders than others. For example, I do like stock and options when it comes to swing trading, whereas day trading, I do prefer futures or currency. And so every trader is going to be a little bit different. Realize this: One of my mentors, a good friend of mine from back in the day by the name of Jeff Crystal, he told me one time, traders trade anything. It doesn't matter what it is. If you got a setup, you take the if you got an edge, you take it. If you got a probable edge, you take it. You don't have to really kind of focus on one or the other, but over time, I think all of us gravitate towards certain instruments that we prefer. And I would say, for the most part, beginner level traders should focus on stock first, options second, before they get into the high leveraged environments that futures and currencies can often accompany. And so when you're looking at the financial instruments, realize anything can be a tradable asset, anything can be a swing trade, anything can be a day trade. Jesse Livermore, he was day trading 100 years ago. Anything can be a day trade, anything can be a trade, but certain instruments are a little bit better. And when you're looking at the beginner level stuff, I would focus on things that are not high leverage, not when you're using other people's money. If you're going to risk some money, risk your own money first before you risk the banks. They might have something to say about that. And so, by definition, we're simply looking at a trade within 2 days to 2 weeks. But my personal definition is pivot to pivot. And I'll talk about what a pivot is here in just 1 second. Now, in tackle trading, we believe in all forms of analysis at tackle trading. There's a lot of coaches at tackle, and we've all been trained in similar capacities. We all have our favorite types of analysis. I love it all. I love economic analysis. I love monetary analysis. I love behavioral analysis. I love fundamental analysis. I love technical analysis. But technical analysis to me is the truth of the market. It might not be my truth. It might not be your truth, but it is the market's truth. And so, regardless of what my opinion is for the future of the US economy or the US debt or inflation or the monetary environment, it really doesn't matter what I personally think regarding these macro conditions that I don't have control over. It is not me that is making those decisions. And so, if I don't have control of the decisions, I really don't know what the central bank, for the most part, is going to do in 6 months from now. But again, that's a lot of opinions. We all like to have those opinions. But when it comes to the truth of the marketplace, the truth of the market is based on price. It's not based on what people say, it's based on what people do. And it doesn't matter if Jamie Dimon comes out and says, I'm going to fire everybody that ever even has the gall to mention Bitcoin. If Bitcoin's going up, I promise you, Jamie Dimon's buying Bitcoin. In fact, we kind of know he was buying Bitcoin after he made that statement. So it wasn't the truth of what he was saying. The truth was what he was doing. And that it has to be reflected in price. What anybody says in an interview has nothing to do with price. But if every single one of us watching this webinar right now go out and buy Amazon stock, for example, that buy has to be reflected in the price. And so the price is the truth of the marketplace. It might not be your truth. You might disagree with it, but it is the market's truth. And I would highly recommend you don't go against the market. The market wins. You don't. You need to kind of understand the market so you can kind of follow where the market is going. Now, the three pillars of tackle trading are very, very simple. Price is king, price is queen, price is everything. Price is everything to us. We focus on the technical read. Number two, price moves in cycles and trends. It doesn't just go straight up. Yes, I know right now we're all going through a parabolic up move in the marketplace, and it's going to go to the moon, and it's not going to stop at 4,600. It's going to go to 5,500 without a retracement, without a high base, without anything, right? It's just going to go up and up and up and up and up and up and up forever, because nobody in the market is ever going to lock in profit. That always happens, right? No, come on. We all know that's not true. Traders lock in profit. Traders, when they get to the overextended levels, they're going to ring the cash register and bring that money in. Price moves in cycles and trends. We do not chase. If we feel, if you even feel like you're chasing something in the market, you got to ask yourself a question. Are you the last one to buy? If you are the last one to buy in a cycle, you are the first one to lose. We don't want to be that guy. And so we need to understand the patterns that work within these trends so that we know when to step on the gas and go, 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 versus when to tap on the brakes and start locking in some profit. That's the cycle we're talking about. And the short term cycle in the market is not based on these macro trends, it's based on three simple patterns. And we need to understand those three simple patterns. And then the last point in the three pillars is to the moon, Mark. History repeats itself. There is nothing new to the market. We've seen it all. It's been it all. We need to understand that history repeats itself. Now, the basics of swing trading are three things. Number one is understanding the direction of the trend. Just where's the river flowing? Where's the market going? We want to know where the direction of the trend is going so that we know what direction we want to trade. When it comes to trading, guys, it is not just bullish. You don't just put the bull hat on. You put the bull and the bear hat on, right? You sometimes wear the bull hat and sometimes you wear the bear hat. But traders, it goes up or down. It really doesn't matter. We want to identify the trend because the trend is what determines the direction of the movement. And we always want to trade in the direction of the movement. Where's the market going? Not where the market was. That's the trend. Now, the trend doesn't tell us when to trade, though. The trend just tells us the direction we want to trade. It is the pattern that determines the trade. And so we wait on certain patterns that develop within trending analysis that determine the probability of the immediate next movement. And then the third thing we always do, and what I would define as the most important concept in technical analysis, and I would argue it's one of the most important concepts in all of the financial markets, but in technical analysis, I would say it truly is king, queen, and it reigns supreme: support and resistance. If one thing you master out of this webinar, if there is one thing you learn out of this webinar, it is to buy at support. That is the number one thing you need to understand when it comes to the basics of swing trading, is we buy at support. That one thing will ensure that you are never chasing stock and you're never the last one to buy. We want to buy at support. We want to sell at resistance. Support and resistance are interchangeable. These are what we call pivot points. And I'll talk about those in the creation of those here in just 1 second. Now, when it comes to trending analysis, a very simple way to describe a bullish trend is you're walking up the stairs. And every stair you take, you have a higher level of floor. And every step you take down, you have a lower level of floor. And so if you walk up the stairs, you constantly just walk up a higher level, a higher level, a higher level. And that is a higher high, higher low. And so when you're looking at trend analysis, a simple way to understand trend analysis is a simple understanding of a higher high and a higher low. Now, what that higher high is, it is the higher level of resistance. What a higher low is, let's see if my Epic pen here works. What a higher high is, it is the increase of resistance. What a higher low is an increase in support. And quite frankly, I don't care if this trend's been going on for 6 days, 6 months, 6 years. We're not the traders at Tackle Trading to be like, ooh, that's been way too good. We're way too long. No, we're the type of traders at Tackle Trading that, oh, that's very consistent. Let's attach ourselves to that trend. And so as long as this trend stays consistent, we're just going to attach ourselves to the trend and wait on those certain patterns that develop within the overriding trend, if that makes sense. And so on the higher high, higher low side, that is how we define a bullish uptrend. Now, a bearish downtrend is just flip the chart upside down. And for you veteran traders, you know this, it's old hat to you guys. But when you're talking about new traders oftentimes struggle a little bit on the bearish side of the equation, because in our lives, we don't think about the bear side. We don't think, we kind of fear it a little bit, but we don't think about making money on the bear side. from the time we're born, we're taught to buy things. We're taught to buy this, buy that, whether it's a consumer or an entrepreneur, buy. Well, when you come into the world of finance, you realize things are equal. For every buyer, there's a seller, and for every seller, there's a buyer, and for every bullish trend, there's a bearish trend, and for every bullish pattern is a bearish pattern, for every support level is a resistance level. And you know what? The 5 techniques I'm going to teach you tonight on identifying support are the exact same 5 techniques that I'm going to teach you tonight on identifying resistance. Everything on the bear side is just flip that chart upside down, and now we're talking bearish conditions. The one thing I would suggest on the bear is bullish analysis is based more on greed than fear. Bearish analysis is based on fear more than greed. And so which one of those emotions is often a stronger emotion in you? For example, when I get greedy, it's not like it hits me like a Mack truck. When I get greedy, it's like a slow build over time, right? It's like, ooh, a little bit here, a little bit there. Oh, I like that. I like this. Oh, man, do you see this market? Oh, do you see the cycle start? Oh, we got a double top. Oh, yeah. It's a slow build over time. It's like a slow boil. Fear, Mack truck. Fear hits you fast. It hits you hard, and it hits the market fast too. And so on the bear side, which is driven through a lot of fear, oftentimes you see a stronger movement. You see quicker price levels. You see more volatility. And so oftentimes the volatility is oftentimes faster to the downside than it is to the top side. Now, for aggressive traders, they love what I just said. For new traders, they probably don't. New traders typically focus on the bull side a little bit more than the bear side, but you really want to get to the point where it doesn't matter, guys. If the market is bullish, we're bullish. If the market's bearish, we're bearish. If tech is bullish, we're bullish in tech. If comms is bearish, we're bearish in comms. We follow the trend. We can't apply our personal bias to the marketplace. I can't associate with this trend my personal opinion on what should happen in the US economy, what President Biden should do over XYZ situation. None of these are in my control. None of them are. I cannot associate my bias with the market's opinion. I have to follow the river. And the river in bullish tells us we want to buy, and the river in bearish tells us we want to sell, and we just rinse and repeat. Our main man, Jesse Livermore, said it best: a prudent trader never argues with the tape. It doesn't matter. Markets are bullish, we want to be bullish. Markets are bearish, we want to be bearish. Markets are never wrong. They're not. When you argue with the market, you're wrong. The market's never going to care about your argument. You're wrong. You're yelling into a void. You're yelling into an echo chamber. You're yelling against billions of other people that are looking at the same data, the same economic analysis, the same projections, the same valuations, the exact same things you are, but has a different outcome, has a different opinion. And so we're never going to get to the point where we can interview everybody. So we focus on the trend. The markets are never wrong. Opinions are. We do not apply our opinion as a short-term trader. We apply our analysis. Now, pattern recognition happens within a trend. It happens within a trend. It happens at the end of a trend, and it happens at the beginning of a trend. One of the things I'm going to talk about tonight that I hope you guys really, really, really enjoy, and I hope it really helps you understand a couple different concepts, the differences between swing trading, position trading, and also the life cycle of a trend in the beginning levels of a trend versus the ending of a trend. And I hope you would agree with me. Usually I like to ask a lot of questions in a webinar like this, but with the 30-second lag in YouTube, it doesn't really work out very well. But I hope you agree with me that if you can understand the beginning of a trend versus the end of a trend, that could significantly change the way you see the market and how you see the markets behaving. I think we would all call this webinar a really big success. And if you do like that, make sure you hit that like and share. Patterns happen within all aspects of trend analysis. You have and the basic types of patterns are continuation patterns versus reversal patterns. Those are the basic two categorizations of patterns in the market. Reversal patterns reverse the previous trend. And if you ever want to watch a webinar on reversals, I've I've done a couple of them. I've done a couple YouTube webinars specifically on the art of the reversal. Just go to our Tackle YouTube channel and look up the reversal. You'll get a lot of reversal analysis in that. So reversal analysis ends trends. Continuation analysis will either continue the previous trend or it starts a brand new trend based on the previous trend. And so we'll get into that a little bit here tonight, but that's a little bit more of an advanced concept. Pattern recognition is also built into our DNA. It's part of every aspect of life. We identify pattern recognition in so many different things. Some of the earliest patterns out there were just the constellations in the nighttime skies. When it looks for patterns, and once you master patterns, guys, you can't not see it. The analogy I always give, or the story I always tell to help people understand pattern recognition in the financial world, is when you go up, and you're going up into the Utah mountains, you're 10,000 feet in the sky, and you're looking at the most beautiful nighttime sky you've ever seen in your life. It's crystal clear. You see a billion stars, and you find the 7 stars that make up the Big Dipper in a matter of 1 second. And how do we do that, guys? Every one of us can do that. Every single one of us here can go find the Big Dipper in the nighttime sky, those 7 stars in a billion star landscape, because we know what the pattern is. If you know what the pattern is, you can see it clearly and you discount everything else around it. The same concept applies when it comes to technical analysis. When we look at a trend, and that trend just is just completely 45,000 different candles with some up, some down, it's hard to decipher all of that. But if you've been trained and you know what to look for in those billion different candles, guess what? You can identify the 4 that make up a high base, or the 3 that make up a flag, or the 6 that make up a retracement, or the 3 pivots, i.e. 15 days, that make up the shortest term of a cup and handle. You can identify those things the same way you do in the nighttime sky. Do not make this more complicated than it has to be. A pattern here on the screen. Triangle, circle, triangle, circle, triangle. What's the next most likely pattern? Don't overthink it. What's the next most likely pattern? If this pattern is consistent, yes, there's variables. I could be trying to trick you. I could be trying to teach you a very, very important concept, those variables. But the reality is those variables existed every second that the pattern existed. And that's the thing you guys got to realize here. What you think you know has already been priced into the market. It's already been talked about to just levels you would not even understand by everybody in the marketplace. And that variable was here, that variable was here, that variable was there, that variable was there, and that variable was there, and that variable was there every single day that this pattern was still consistent. And so what's the next most likely pattern? Yeah, it would be a circle. Now, star, star, arrow, star, star. The next most likely pattern, well, it would be an arrow. And so when it comes to pattern recognition, it's really simply a matter of understanding the historical pattern. And all we say is that's going to continue. We're the traders at Tackle Trading and saying, okay, that pattern's just going to continue. We are not the traders at Tackle Trading to be like, ooh, let's go against the market. Yeah, let's go against all that momentum. Let's do that. No, we just, honestly, simple. We identify the pattern and we trade in the next most likely pattern, which is based on the historical understanding of the trend. Now, it's a little bit simple when you look at star, star, arrow, or triangle, circle, triangle, circle. What about within a pattern? What about within a trend? Well, when you're looking at a trend is nothing but a series of higher highs, higher lows. You have a higher high, higher low, higher high, higher low. That is all that trend is. Now, in that trend, though, are 3 basic patterns. And it's the 3 patterns we need to understand so that we know what to, in general, do. And the first pattern that starts a trend is what we call a bullish breakout. When a breakout occurs when it breaks the previous area of resistance. When that breakout occurs, if it happens within a trend, that's just called a bullish breakout. If it happens at the end of a trend, guess what it's called? You guessed it, a bullish breakout. It's still a breakout. They can happen after continuation patterns. They can happen within a trend. Anytime you break the previous pivot of resistance, that is a bullish breakout. Breakouts are based on momentum because momentum has already went up. The market had already established the higher level of support. It has already established it's walking up the stairs. And so when you break out, you're stepping above the previous stairs to go into that higher high. And so it's based on momentum, given the fact that the bulls already have control and they're already driving the price up. And so the first pattern that you see that starts a trend is called the bullish breakout. When the breakout occurs, we're expecting it to increase resistance, and we want to associate ourselves with the momentum of the environment. Now, the second pattern that develops within a trend is what we are currently kind of dealing with in the market right now. Right now in the market, after 3 weeks of nothing besides euphoria, guess what? We're range up. We're overextended. There's been a little bit too much froth there. There's been a little bit too much buying pressure. There's been a little too much chasing. We're in general overextended. And once you get into that concept of overextended, you go into pattern watch because you do not want to be the last to buy, right? You don't want to buy at the end of a nice little movement in the market. You want to buy on the dip or you want to buy on the breakout. You don't want to buy as everybody else has already bought. And so as it gets into the overextended conversation, we go into pattern watch. And you hear us talk about this a lot at Tackle Trading. Now we're waiting. 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 We're waiting on a pattern. We're waiting on a pattern to develop so that we can reset the technical trend. And so that we're not the last to buy any longer. We're now at the first to buy. And that can certainly be a high base or that can be a retracement. We'll talk about that here in just a moment. But the second pattern that develops within a trend is that overextended concept. And again, simply because it's overextended does not mean, hey, let's get out and short. No, no, no. You're going against the market. The only thing that's going to occur here is traders locking in profit. Nobody's dumping their long-term stock here. Nobody's making radical choices here. Nobody's shifting every volatility and concern here. Traders are legitimately just locking in profit off an extended move. That's it. And so you wait on them to stop taking profit when it gets overextended. You wait on all of us to stop taking profit when it gets overextended. And then you go into the third pattern, which is often the case, what you would call as a pullback. Now, pullbacks have been called many different names over the years. I don't think breakouts have. I think it's always been a breakout. Pullbacks have been called a lot of different things. BFTD, anybody? Buy the dip, baby. That's certainly part of the conversation. Bullish retracement, flag-based patterns, bull pullback. They all refer to the same thing, is waiting for profit taking to happen, waiting for the price to alleviate itself. Got a lot of pressure on the price at the top end of a trend. Not a lot of buyers, a lot of pressure. Wait for that pressure to alleviate itself and then get in. If you ever want to learn to buy the dip properly, learn how to understand a bullish retracement and the 5 categorizations that make up a solid bullish retracement. So you don't ever have to get to the point of, hey, is this the time to buy the dip? Is that the time to buy the dip? Is this the time? Are you buying the dip? Are you buying the dip? Who's buying the dip here? If you're buying the dip and everybody's buying the dip, maybe I should buy the dip. And by the time you get done making that decision, it's back up here. And by the time you said, okay, it already went. And now what are we traders doing again? By the time you've convinced yourself that, yep, it's time to buy the dip, it's not at the dip any longer. You got to make those choices fairly quickly here. And so when it comes to the patterns that develop within a trend, there's not a lot. You got the breakout that creates a trend. You got the overextended that tells us we want to tap on the brakes. and then you wait on the inevitable retracement, and then we look to reset it to a certain extent, and it just rinse and repeat. Now, when it comes to the cycles in a trend, let's understand the basics of what we were just talking about. But before we do that, I want to talk a little bit about the life cycle of a trend. And this is what I feel is one of the there's a lot of important concepts when it comes to swing trading, but one of the most important concepts I would say is the understanding of the life cycle of a trend. The beginning part of a trend versus the ending part of a trend, knowing how to approach that, I think is extremely important. Do you want to swing trade? Do you want to day trade? Do you want to position trade? I think all of those questions get answered if you understand the life cycle of a trend. And can we all agree that the life cycle of a trend, if we could all go back to 2009, in April of 2009, when the market broke resistance for the first time after the subprime meltdown, that every single person here watching this would be financially better off today if you just got in at the very beginning of the largest market cycle trend we've ever seen in the history of mankind, not including tulip mania 500 years ago? I think the answer is yes. And I think the answer would also be yes, that if by 2015 you started seeing reversal analysis, you might have wanted to take a little bit of that off the table. Understanding the birth and the end of a trend is vitally important. And that's all wrapped up in what I call the life cycle of a trend. Now, in the life cycle of a trend, I hope it will help everybody understand that at different parts of the trend, different cycles of the trend, we are going to behave a little bit differently. Now, when it comes to the types of traders, there are four types of traders. You got day traders, swing traders, position traders, and investors. Day traders are looking to get in and out in the same day. A lot of day traders will focus. There's a lot of day traders in stock and options, and I understand there's a lot of popularity over zero DTE. And I think that popularity over zero DTE is people that just haven't learned that there's futures in Forex yet. I think when they learn there's futures in Forex, especially with Forex starting to kick off again, those are a little bit better day trading environments. I do have a bias there. That is a subjective opinion. Other people, we can agree to disagree on the best day trading environment. Some people will say crypto. Some people will say currency. Some people will say commodity. Some people will just say the S&P 500 E-mini contract. Everybody's going to have their, let's face it, everybody's a precious snowflake when it comes to the world of day trading. But in swing trading, it's really consistent from a pivot to pivot perspective. Position trading is a little bit longer term. You're typically measured in weeks to months, not days to weeks. And so position trading is typically you're trying to capture multiple moves in the market, not just a single move in the market. Swing traders try to capture pivot to pivot, which is a single move in the market. When you're trying to capture multiple pivots, that's a position trade. You're obviously going to be longer term there in the analysis. And so in general, you're trying to capture the entirety of a trend. That's kind of the desire when you go into a position trade, is to be in the trade weeks to months and capture the entirety of that trend. Some of the most famous traders of the position trader status were the turtle traders, the Richard Dennis historical case study of the turtle traders of the 1980s. Those were some of the most famous position traders of all time. Investors, they're not part of this conversation, because they're not going to get in and out at different stages of shorter intermediate trends in the market. Investors are really looking big picture. They're measured in years to decades, not weeks to months here. Now, when it comes to the life cycle of a trend, once again, this is what I feel is one of the more important parts of just the basic understanding of the differences between swing traders and position traders, but also a very helpful tool in helping you understand where you're at in the beginning or the ending of a trend. Remember what a trend starts with. A trend starts with a breakout. That's where it starts. A company first comes out as an IPO, for example. It comes out as an IPO. There's no trend, guys. There's no trend in an IPO. You can't tell me what the IPO is going to do because there's no historical association to how the market is going to behave over that stock, over that price. IPOs are all hype. That's all they are. They're overvalued hype. That's it. If you want to focus on IPOs, that's great. That's not something I focus on at Tackle. But I will tell you this, when it comes to IPOs, the birth of a trend does not occur on the IPO. The birth of a trend occurs on the first pattern and then a breakout one way or the other on that pattern. And that occurs a couple months, quite frankly, after an IPO. And ARM here was one of those stocks recently that just had the birth of a trend. And for those of you that are looking at ARM now, I'm sorry, you're late. You're late to that party. But if you're a pro member at Tackle Trading, we had ARM on our watch list. We talked about it all for in many different programs. We tracked this breakout for about a month in our community before it eventually actually broke out. But my general point is not to brag about the ARM trade. My general point is to understand that the birth of a trend does not happen on the IPO. You do not have the information on an IPO to be able to say, oh, what is that trend? All you have is volatility. That's it. You don't have a trend, because to have a trend, you have to have multiple different pivots, and you don't have that for at least a month and a half to 2 months after the birthplace of a stock, and that's the IPO. But once you break out of resistance right here on that big old green candle, guess what? Now you're in a trend. You have that birth of the trend because you broke out of the previous area of resistance. And so when you're looking at the marketplace from a life cycle perspective, understand this. Let's pretend a little bit that that reversal that we just saw on ARM was also kind of my lines here that we're looking at on the life cycle of the trend, because I really do think those are very, very consistent against one another right now. When you're looking at the birth of a trend, it starts on the breaking of resistance. And that's not in a trend that's already going up and breaking out of resistance. That's not what I'm talking about. I'm talking about after a reversal in the marketplace. So price was coming down. After a reversal where the market double bottom, double top, you then break out of resistance. This is called a W formation. A W formation in the market, it's very simple, guys. It looks like a W. W stands for winner. Bullish patterns have positive connotations to them because most people are buyers. Bearish reversals have a little bit more negative connotation. M for murder, for example. So you got the W, which stands for winner. You got the M that stands for murder, and that happens at the top end of a trend. And so when you're looking at resistance here, once it breaks out of this resistance level, that's the beginning point of the trend. And that is a really good timing for a lot of different types of traders. If you were looking to swing trade or position trade ARM, that is like the perfect timing on that breakout against that nice little W formation on ARM. And so at the birth of a trend, this is where your biggest value is, quite frankly, for any time frame of trader, whether you're a swing trader, position trader, whether you're looking for an investment add to a position or create an investment, you're looking to do that at the birth point of a trend. And that all starts with the breakout of resistance. Now, once you break out of resistance, you're obviously going to start walking up the stairs a little bit. And so as it goes up and it breaks out, oftentimes you'll associate breakouts with a lot of momentum, because what occurs in the market, guys, is that first day it goes up, not everybody catches it because not everybody's tracking ARM. Not everybody in the market's tracking ARM over a month waiting on a potential breakout of 64. Only the people that are tracking it get in on that initial breakout. And so once it happens, though, all of a sudden everybody else starts hearing about it. And then all of a sudden it gets into the market cycle. And then all of a sudden it gets into Wall Street. And then all of a sudden you're starting to hear on CNBC how money managers have to chase, because if they don't, they're going to get fired at the end of the year. But at the beginning point, no. But as it starts to develop, you get momentum to associate with it. And that momentum drives it up, 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 until you get into what is technically called a higher high. Now, that higher high is overextended. Once you get overextended, it's done. I don't care if you think it can still fade up. you're done. Wait on a better environment because two things have significantly changed from the breakout to the overextended. Number one, your probability has shifted. You do not have probability anymore. And number two, you have an inverted reward to risk ratio at this point as well, because you can't target anything above where the current price is because it's once again overextended. If you get the gust of the trading gods and they just send it up, 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 and it goes parabolic, you got lucky. But guys, getting lucky in the market's fine. That's great. That's fantastic. We'd all take a little bit of luck in the financial world every now and then, but you can't base your system on you getting lucky on a parabolic movement that may or may not exist at any point in your life. And so you got to be a little bit more structured than just chasing, chasing, chasing. And what we like to do at Tackle is wait on that inevitable retracement. And as it comes back down, it establishes a higher level of support. And this will rinse and repeat until it doesn't. Now, the reality, though, is we know over time this trend will slow down. We know over time that the higher it goes, the more participation you're going to see for it to continue its momentum. And that's just a tall ask, quite frankly. And so there was a technician about 100 years ago by the name of Elliott, and created Elliott wave theory. And Elliott wave theory was basically the life cycle of a trend wrapped up into a bunch of complicated ways to describe it. But the reality is, what they stated was trends move in a series of waves and patterns, and trends historically, as they go into what is known as the fifth wave, have a tendency to slow down and go through what is known as pattern recognition. I call it, like I do it all the time, it's reversal analysis or continuation analysis. That's how we teach it at Tackle Trading. But back in the day, that was called the ABC cycle. We look at it just from a simple pattern perspective now. It's the same concept, quite frankly, but it in back 100 years ago is the ABC cycle, and it would reset the trend. And so what a wave is the upward movement in price that is called a motive wave up. The waves down are called corrective wave down. And so it goes motive wave up, corrective wave down, motive wave up, corrective wave down. And so whenever you hear somebody at Tackle say, I'm going to ride the wave, they're just looking at a trade. That's all they're doing. They're looking at riding the wave of pivot to pivot. They're looking at riding the wave count. If somebody's at Tackle saying, no, I'm looking at more position trade analysis, they're not looking at just riding the momentum. They're looking at holding through these pullbacks and try to capture the entirety of the trend. And so, for example, one difference between swing traders and position traders, we all love buying that breakout. Swing position, it's all the same. The difference is going to be stop loss management. The swing trader will take that stop loss and adjust it throughout the wave until it inevitably comes down and you get stopped out. That's kind of how that works. Whereas the position trader, they will not do that. The position trader will have a stop loss and they will not budge that stop loss until it establishes a higher level of support. And then they're going to adjust that stop loss over time. And so entries for both swing traders and position traders can be very, very, very similar. The difference is how you manage that trade from a stop loss perspective. The swing trader is going to be more aggressive in stop loss management as the wave goes up, 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 up. They're going to be locking in profit as it goes up. Whereas the position trader, they're not going to do that. They're looking to capture the entirety of the trend. Now, as the trend continues to go up, 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 what you will start to see as it goes higher is it starts to slow down a little bit. And as it starts to slow down a little bit, we call that slowing momentum. And as we start to see slowing momentum, again, it's not the ending of momentum, but it's a precursor to that. Then you start to see reversal analysis. And so the life cycle of a trend starts with a breakout, following a reversal formation called the bullish reversal. Once it establishes that higher high, we just walk up the stairs, higher high, higher low, higher high, higher low. And as the market goes up, 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 when do we want to tap on the brakes? Not when the market has momentum, but when the market starts to slow its momentum. And how it slows its momentum is the vertical distance in the wave count. And so when you see the pivot here to here go from here to here, you see that pivot go from about 117 up to about 147. That's a nice little 30-point movement there in the marketplace. Now it goes from 135 to 155, a 20-point movement. Market's still bullish, but it's slowing down. It's like the yellow light at a stoplight. You're supposed to tap on the brakes. I'm talking to you guys who don't. I'm kind of like that too. You're supposed to tap on the brakes when you get a yellow light. It's a caution sign that you're slowing down, but it only gets confirmed once the resistance level is now held. And then once support violates in the reversal, you have the new birth of a downtrend. And so when you're looking at trending analysis, again, it starts with the reversal. That reversal then breaks out of resistance. You establish a bullish uptrend. You track the momentum in the trend. You're tracking the three patterns within that trend. And at the end of a trend, you often see slowing momentum and then a reversal. And you know what? We love doing at tackle trading. Here's one thing you guys are going to love doing at tackle trading with us. We love reversal analysis. And maybe I'm projecting a little bit there. I love reversal analysis. It's one of my favorite parts of technical analysis is tracking reversals because they can be really consistent. But the reason I love tracking reversals, guys, is because that's the number one time you should be getting involved in a trend, is at the birthplace of a trend. And the birthplace of a trend is absolutely through reversal analysis in the financial markets. You saw an example of that with ARM, but I could obviously pull up a lot of examples coming from the low point in the market right now as well. When you're looking at that uptrend, once again, let's simplify it for the new traders very quickly. In an uptrend, you basically have a series of higher highs, higher lows. At the higher high, that's where you've had a lot of accumulation. Well, that accumulation, it's got to be distributed. And so as it gets to the higher high, you go through a distribution phase and it brings the market back down. As the market comes back down underneath the primary growth trend, you get an accumulation phase. And this is just a rinse and repeat cycle that never ends because it's a never ending saga. When you're looking at the simplified pattern, it's really just a matter of a higher high, higher low, higher high, higher low. What do we like to buy in the higher high, higher low? We love to buy the retracements and we love to buy when it breaks out of resistance. Those are the two primary patterns in a trend that we track: retracements and breakouts. Everything's a breakout. Everything is. Not everything retraces. You could certainly have bases in high bases in bullish trends and low bases in bearish trends, but everything has a breakout. Not everything does, in fact, retrace, but that's a little bit more nuanced when it comes to technical analysis. Now, once again, the core 1, 2, 3 pattern, we talked about this just a little bit ago. The trend starts with the breakout. That's number one. The trend gets overextended at the end of the wave count. That's number two. Number three is the retracement. We buy one, we sell two. And when I mean sell two, we mean lock in profit against what you purchase in one. You are not looking to short an overextended condition. I'm sorry, you're not. That is not a good trade. It will never be a good trade. I don't care how high it is. If it's a great short, you'll get a better pattern than just going against the marketplace, because it could easily high base and it could easily reignite momentum. We do not look to short against a bullish trend. Against a bullish trend, I promise you, if you have a stock that is overextended in a bullish trend, the market most likely is overextended in a bullish trend. Why don't we go find something that's breaking support? Why don't we go find a bearish trend that's now up against resistance? There's better opportunities is my general point. Pattern number three is retracement, and we're looking to buy that as well. Now, once again, when you're dealing with bullish analysis, higher highs, higher lows. When you're dealing with bearish analysis, lower lows, lower highs. You flip that chart upside down, and all of a sudden we're staring down the barrel of the bearish analysis versus bullish. But there's not a lot of key differences in a bear trend versus a bull trend. One is up, the other one is down. One has higher volatility, that's the bear side, versus lower volatility, that's the bull side. Once again, the reason it has higher volatility is fear will always be a stronger impact on our immediate actions then greed will. Greed is a slow boil. Fear is not. Fear is immediate. And so when you're looking at the bearish downtrends, it works the same way. As you get to the lower level, you get oversold here. As you get oversold, the market buys it back up. It gets overbought. We rinse and repeat until the cycle changes. We do not question the cycle. If a stock has went from 300 to 100 and you're like, ooh, man, it was just 300, just like, wow, like 6 months ago. Okay. Doesn't mean it can't go down to 60. Doesn't mean it can't go to 30. Doesn't mean it can't cater another 66%. Doesn't mean it can't go to 10. Doesn't mean it can't go further. We don't question that. We let the trends dictate that. We let the momentum change. We let the pattern speak to us as swing traders, not the other way around. We do not force our opinion against a marketplace. We are looking at you, PayPal. It's still going down there, Chucky. All right. So in the simplified downtrend, we're just walking down the stairs, lower low, lower high, lower low, lower high, lower low. What's the next trend? Or excuse me, what's the next pattern? Lower high. And as we understand these things, we can start associating ourselves with them. For example, the core 1, 2, 3 bearish downtrend. You start with a violation of support. That's number one. That is a shortable situation. As it gets overextended into pattern number two, you wait. Everybody's already piled on, guys. Everybody watching this stock has already done something with it or has already made a decision to do nothing with it. One of those things have occurred. The people that have tracked this stock have either said, I'm in or I'm not, but they're not making decisions right now as it's already made its move to the downside. Oftentimes what occurs is the people that were shorting the stock on the breakdown and the people that started piling on as it went down, they now start to lock in profit. And as they lock in profit, because that's what traders love doing more than anything is locking in profit. Go ask my good friend Gino Poor. He's never made a trade he doesn't want to lock in a little bit of profit on. As they lock in profit, it creates that retracement and it works right back into resistance, rinse and repeat to the downside. Now, let's talk about support and resistance. We understand trends. We understand the patterns that make up a trend. Now, I know there's a lag on YouTube, but as an educator, I always ask a lot of questions because I like to see if you guys are following and liking. And, being an educator, teaching people the basics of trading like this, oftentimes I associate it with cooking. I love to cook. I love to cook. But you gotta know if you're doing it right? So if you're enjoying the webinar here tonight, if you're learning from tackle trading here tonight, make sure to let the coaches know there in the YouTube chat, and make sure to give us a like and a share there as well. Let's talk support. We identify the trend to know the direction we want to trade. We identify the pattern to determine the probability of the immediate next movement. And we identify support and resistance to know exactly when to make the trade. That's kind of the process here. Support is the floor, resistance is the ceiling. Support is created based on an increase in supply and demand. And so as the market is coming down, 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 you have increasing supply driving the price down. As it comes to the low point, you see a shift in the balance of supply and demand that we won't visually identify other than the momentum shifting in the trend or the pattern. And so as price is coming down, it's because there's more supply than demand and the market has to price that in. As it comes to the low point, you start to see that shift and you start to see it shift through momentum and candles. And by the way, guys, if you're liking the technical analysis, I am teaching another edition of the option success training coming up in 2 weeks from tonight. And this technical conversation, I do by about 2.5 times in that class. So if you love technical analysis, want to learn a little bit more about the intermediate stuff, not just the beginner level stuff, get into the option success training. It's free for all pro members. And if you're not a pro member, let's go be a pro member so we can get into that class for free. Price here. Price is coming down, 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 down. Supply and demand shift. Small candles ensue. We get that upward movement in price. That upward movement in price is support. Support is defined by the market as an upward movement in price following a minimum standard of it having to come down. We'll talk about that here in just 1 second. And so as you see the price coming down, 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 it's because supply is increasing as it's coming down. Traders are shorting, traders are dumping, investors are dumping, whatever the creation of the volatility is, it is dumping, and people are piling on. Well, as it gets to the low point, you start to see the candles, and I haven't taught candles tonight. Get into that class. I'll teach them there. But as the market comes down, you start to see the candles in the chart start to shift. They start to shift, and you start to see a little bit of this U shape or V shape type mentality. And so the U shape is what we call a slowing momentum. V shape, same type of conversation, but it's a little bit quicker. But you see the candles get a little bit smaller, a little bit smaller, a little bit smaller because the supply and the demand is shifting. And then when they get really small, we call that a doji. And once the market kind of gives us that doji, that shows us that supply and demand are actually very balanced. There's not an additional supply versus demand. You have a very similar demand and supply threshold. Once you see that upward movement in price, that is the market showing you that now the demand is now winning and support has been created. Support is not the small candles. Support is the area underneath the candles that is confirmed with the upward movement in price. That is support. And that is where you want to buy. As the market is coming down, you wait for the shifting of momentum, and then you wait for that upward movement in price, and then you're looking to giddy up and go at that point. To understand this, let's go through a little bit of detail. And resistance is the same thing, just opposite, guys. Market's going up, 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 up. Resistance is the ceiling, rinse and repeat. Flip the chart upside down. So it's legitimately the exact same conversation. The only thing you have to change is resistance is above the stock, support is below it. Resistance is the ceiling, support is the floor. Resistance is created because demand is shifting it up, 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 up. And then resistance happens, and then supply occurs, shifting the market back down. And so you have increasing supply, thus increasing demand versus the support build. And so resistance is the ceiling. That's really what we need to understand in that slide. Now, this slide here, though, I think will help you understand the creation of pivots and how support and resistance can change our read in the marketplace. Once again, one candle cannot create support, because if one candle could create support, every candle would be support. You got to create certain minimum standards for support creation versus resistance versus minor pivots of resistance versus major pivots of support. There's got to be a set standard there. And so as you're talking about the creation of support, it happens once again as supply is increased, driving demand down. As supply increases, driving demand down, it comes down in the lower levels here, and you start to see those smaller candles. As you start to see those smaller candles, it's because demand is now equal against supply. And as that upward movement in price happens, it's because demand now overpaces supply, showing you a healthy dose of confirmation that now you have support build. And so you had a pretty standard movement to the downside. You get a little bit of slowing momentum and then that upward movement in price. And this just rinses and repeats until it changes, guys. It just rinses and repeats until it changes. And anybody that's ever traded oil knows exactly what I'm talking about here. When you're talking about the trend you see on the chart here, it's just base neutrality. That's it. Pivots have not changed. The pivot at resistance is identical. The pivot at support is identical. When this story changes is when we start getting interested. And so as long as it just stays neutral, we don't care about that. It's just rinse and repeat. Support builds versus resistance builds. But as the market shifts a little bit and you start to see the increasing in support, that changing behavioral analysis tells us a tremendous amount about what's about to occur. Because I'll tell you right now, what's about to occur is it breaks out. Now, not on my chart. I created this chart. Of course, it's going to break out. But on a stock, it is about to break out because you've reset the distance you have to run. A lot of stocks, a lot of commodities have a lot of personalities. You see these personalities accrue all the time. They run the same distance, they get overextended, they go through the same process, they go high base, they go to a flag, whatever the case might be. But they have these types of personalities. And if that changes where you're running from here, all of a sudden now you can see the birth of that trend, and the birth of that trend, i.e. ARM, the example we just went through, you can kind of see that on ARM. For example, let's go back to ARM and let's take a look at it. When you're looking at ARM here, nice little neutrality, real good level at 64 here, ladies and gentlemen. Just a real solid resistance level right there. Now, this technically is what we refer to as a head and shoulders formation. It's one of the more standard bullish reversal patterns. You got the W, you got the head and shoulders. Regardless of the naming of the pattern, what you have is, do you see where it goes from this level of support to now this level of support? That increase in support is extremely significant. I know it doesn't look like it. You're just looking at all these different candles, but that specific pattern stands out to me like a sore thumb because it increases support. And you can't have a bullish uptrend unless you increase support. And if you don't increase support, you're just going to be overextended going into every single resistance test. And thus you get snuffed out every single time and it comes right back down. That increase in support, that is extremely important when you're talking about the birthplace of that trend and being able to make a trade on that, whether that trade is a swing trade or a position trade. You're looking at that increase in support and saying, oh man, this is getting ready for prime time. And so once that increases support right there, that's the telltale sign that the market is giving you. It's like you're sitting at the poker table and over a 6-hour time frame, every time Coach Mark like scratches his ear, like you can tell he's a little bit nervous and he's just scratching his ear and he's just playing with his earlobe and he's like, oh yeah, you don't got that. You're bluffing. By the way, Coach Mark doesn't bluff. I wouldn't play poker with him because he doesn't bluff and he'll sit at that poker table for longer than you will. And so he has a little bit more stubbornness than the rest of us do. But you get my point. It's like that tell and you see it. Well, the market's giving us a tell here. It's increasing support. And as it increases support, that gives it fresh legs going into that potential breakout. And that's the importance of understanding this pivot conversation, is it really tells you when you're going to about to see a breakout occur. When it breaks out, we look to giddy up and go, go, go. Now, we talked about the trends. We went through the life cycle of trends. We talked about patterns and the patterns that happen within a trend. Now let's end on the catalysts that occur so we know where to buy and sell. And this is what we refer to as technical catalyst. Remember, support is always created by the marketplace, right? It's a shift in supply and demand. But where these levels occur, where these shifts in supply and demand occur, are typically at known levels of support and resistance that have been well documented over a very long time. And so when it comes to support, number one, it's always defined by the marketplace, but we always need to be prepared about where that's going to form. We need to be prepared because we need to know where to place a stop loss. We need to know when to get involved in a swing trade. We need to know when to expect that support build. We need to be prepared to put that trade on. And so when it comes to technical catalyst, a catalyst is not by definition support or resistance. A catalyst by definition is just that. It is a catalyst. It can act as support and resistance. It can be the end all be all of support and resistance. You can anchor against that catalyst as much as your heart desires, but it is not the textbook definition of support. Support is an upward movement in price as defined by the marketplace, but it is that catalyst where we look to catch these support builds. And so there's 5 different types of catalysts that we like to track in the marketplace. The first one is what I refer to as the principle of polarity. This is based on a pivot in the marketplace. When a pivot has occurred in the marketplace, whether that is a minor pivot and it like 3 days down, pivot went right back up. That would be a minor pivot. If a minor pivot in the market occurs, is it still support 20 years from now? Yeah, it is. Now, whether or not I give any credibility to it is a different conversation, but it's still support. Once those levels have been identified, guys, support and resistance is interchangeable. There's been some stocks this year that have been so bad that they are not underneath their pandemic price. They're not underneath their subprime meltdown price. They're underneath their .com price. That's how bad some stocks in this market have been. And if you were looking to short those stocks, and we've done this in our scouting reports numerous times, if you were looking to short those stocks, you couldn't go back to the last 6 months or 12 months to find a level of support because it hadn't been there in 25 years. And so you would have to go back to a long time to understand this. By the way, the cycles of the 1930s, 40s, 50s, and 60s are still referenced today regarding the consistency of the market cycle. And so, yes, the answer is yes. Once a pivot has been created, it can always act as a future pivot. That doesn't mean we're going to give every single pivot credibility. There is a difference between a 3-day pivot and a 13-day pivot. There is a difference between a 3-day pivot and a 21-day pivot. There is a difference between if those pivots also coincide with multiple time frame analysis that are pivots on weekly charts and monthly charts or intraday charts. And so not every pivot is created equally, but yes, they will always act as a support or resistance level, or they can always act as a support or resistance level, regardless of if that pivot was 6 months ago or 60 years ago. A pivot is a pivot, but they're not all created equal. It's kind of how I see it. Once support is created, it will be interchangeable against support and resistance. Once resistance is created, it is interchangeable against old support or resistance. What about trend lines? Moving averages are certainly my preferred gauge of vertical trend lines, and that's how I would describe trend lines in general, is they are vertical levels of support and resistance. They are a form of moving support and resistance levels. Moving averages are probably a little bit better. They're probably a little bit more accurate, and the algorithms certainly don't ask to see your trend lines to make decisions on their algorithms. And so I do prefer moving averages, but if you are going to draw your trend lines, and yes, I still draw my own trend lines every now and then. I think Tesla has a beautiful symmetrical triangle pattern right now. By the way, that's more of a trend line tool, not a moving average one. A moving average one would call a pivot, or excuse me, a pinch. And so when a moving average pinches together, that's very similar to a symmetrical triangle. I'll draw the lines for Tesla just so that you can see it. But trend lines are simply you're connecting the dots. That's all you're trying to do. Now, the number one mistake I see people make in connecting the dots is they will connect a minor pivot. They'll connect a major pivot in the past with a minor pivot in the current, and they think that's their current trend line. For example, they will take this right here and they will draw that just to justify, hey, this is a buying opportunity. No, it's not. Yeah, it is. Look at the trend line. That's arbitrary, not consistent. But I connected two pivots. You connected one pivot and a hypothetical hopeful pivot of the future. That's not an accurate trend line. You cannot connect a major pivot to a current minor pivot and say that's an accurate trend line. That you're not talking about the same trends there. You're talking about vastly different trends. And so when it comes to drawing pivots here or drawing your trend lines, you really got to get to the point where you can draw like pivots. And so you connect major pivots, you connect intermediate pivots, you try to connect as many consistent pivots as you can, and that gives you that more consistent trend line. And if you're drawing trend lines that are parabolic, you got a lot of hope in your life, and that's a good thing. That's a good thing to have hope in your life. But don't let that hope get broken because when you lose all the money in the marketplace because everything is overextended. You got to make sure you're accurate when you draw those trend lines. And if you don't know how to draw a trend line, I got some really, really, really good news for you. You don't have to. because the next form of catalyst are what we call moving averages. Moving averages are very similar to that of trend lines in the sense that you're trying to draw what is known as moving support levels. These are not support levels where we're expecting the price to hit today, but somewhere down the road. You can look at trend lines there. You can look at moving averages there. Both are really, really, really good. Both are really, really, really helpful in that environment. The moving averages we like to anchor against are the EMA of the 5, 9, and 13. Those are more day trading and aggressive swing trading ones. The combo hard 14, 5, and 9. Definitely check out the hard 14 course. It's on discount. It's one of our premium systems. That hard 14 course you'll master moving averages there. By the way, I am a believer in moving averages today. I was not a believer in moving averages 5 years ago. I would have put moving averages there with every other form of catalyst, very similar to trend lines. Today, I swear at the altar of the 9 EMA from a momentum perspective, and that is all about Coach Mark and the work that he put into the hard 14 and helping me understand how these moving averages are vital for our understanding of short-term, intermediate, and primary areas of moving support. And I just loved it when he put it like that, that yes, moving averages are moving because they are telling us where support is going to be in the future. They are telling us where resistance can form in the future, not just the here and now. And so the hard 14 is a wonderful, wonderful short-term support and resistance level. Fibonacci retracement levels are certainly still viable in the market today to understand support and resistance levels as well. I'm not going to go into detail, obviously, in a beginner level swing trading course, understanding patterns and trends and support and resistance. But for you advanced traders, I still love me some Fibonacci retracements. There's no doubt about that. In fact, Fibonacci retracements are the number one way I track the depth of a retracement. The second way is moving average based, but my preferred gauge is from a Fibonacci perspective. And then the last way to identify support and resistance is significant whole numbers. $5, $10, $20, $30, $50, $75, $100, $150, $200, $250, $300, so on and so forth. Numbers that often are associated with currency denomination also create a significant psychological reaction to them as well. These significant whole numbers are really what they are they're psychological based, and they allow us to really kind of understand the basics of why somebody buys at $10 and why they don't buy at $9.99 or so on and so forth. And so significant whole numbers are more psychologically based. They create behavioral situations in us, and we have a tendency to gravitate towards them, and they're often associated with currency denominations. Now, we talked a lot tonight. Once again, I hope you really enjoyed tonight's webinar. We talked a lot tonight about trends, the life cycle of a trend, patterns that happen within a trend, the differences between swing traders, position traders, and the understanding of what creates support, what creates a pivot, and how pivots can help us understand trend analysis and support and resistance. Had a lot of fun here tonight, guys. Really enjoyed as an educator, really enjoyed tonight. I hope you guys did as well. If you love Tackle, you love the program here tonight, you learned something, hit that like and share, help us with the Google algorithms. The last thing I'll say is this. Our good friend Jesse Livermore said, do not anticipate a move without market confirmation. Being a little late in your trade is your insurance that you are right or wrong. Being a little bit late is insurance. You hear Coach Mark, Coach Frank, well, not Coach Mark, you hear Coach Frank say this a lot. Just pay the premium. That's a way of Coach Frank saying, wait for the confirmation. Because you're paying a little bit of insurance. Yeah, if you have to buy XYZ stock 30 cents above where you wanted to, that's one thing. But it's also the insurance that you are right, that the market thought you were right, that you are not going against the marketplace. So do not anticipate a move without market direction. Wait for Marty to jump. Wait for my best friend Marty to jump. We want to play with Marty when he's jumping on the trap, not when he's hanging out, sitting down, and maybe breaking my trap. Wait for him to jump. That's what confirmation is waiting for the price to bounce, waiting for Marty to get that trunk going up and down and that big old smile happening and having some fun on that trampoline, waiting for the bounce to occur. Do not anticipate a move without market confirmation. Being a little bit late in your trade is the insurance that you are right or wrong. As the market is coming down, 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 we talked about the slowing momentum of candles, the slowing momentum that occurs within a pivot. Well, as that market is coming down, oftentimes we see these big black, these big red candles, right? These candles coming down, 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 down. Well, as that shifts its momentum and all of a sudden you see a small candle, that small candle is the slowing momentum candle. That is where you have the supply and demand get more balanced, but nobody's winning the battle yet. You don't want to fight the battle. Remember, that's one of the hallmarks of tackle trading. We love to lead in so many things in life, except this. We got to wait for confirmation. We got to wait for the market to prove us right. And that's the third candle here. That upward movement in price that closes above the previous candle's wick, that is confirmation. And so you get the preceding candle, you get the bounce. This is Marty getting ready to have some fun. And then you get the confirmation candle. And that is your insurance. You are right. And that is coming to a conclusion of Swing Trading 101. Presented by Tackle Trading. This has been your coach, Coach Matt Justice. It's been a pleasure to be your instructor here tonight. I hope you guys enjoyed a tremendous amount. I see Coach Sylvia has already put her consultation link into the YouTube chat there. If you need to hit that link. You can always sign up for a nice little 30-minute consultation with Coach Sylvia to talk about all of your needs. One last quote from Jesse Livermore, and then we'll talk. Then we'll kind of conclude with some final thoughts here. It is literally true that millions come easier to the trader after he knows how to trade than hundreds did in the days of his ignorance. You don't know what you don't know. That's my last thing I'll say. You don't know what you don't know. There's a lot of ways to find financial success in the markets. There is a tremendous amount of ways. Tackle doesn't have them all. There's a lot. There's millions of different paths you can take. There's a million different roadblocks, a million different variables, a million different things that can stop you from achieving what you are setting out to achieve. And I don't know what your 2024 goals are, but I'm willing to bet when you sit down around New Year's, you're going to write down some financial goals. And you're going to want to obtain those financial goals in the fastest way possible. And I'm probably willing to bet you wrote down some financial goals last year. And I'm probably willing to bet you wrote down some financial goals the year before. And we all did. I do, you do. I'm going to do the same thing. I'm no different than everybody else. I'm going to do the same thing. And I'm going to identify the needs and the people that I need to surround myself with to achieve whatever goals I set forth. Because we don't do it on our own. Can it be done on its own? Of course it can. I've met a lot of traders that have learned how to trade in a lot of different ways. I've learned traders that picked up books and just learned how to trade from books. I've known traders that have learned how to trade from YouTube. It's not the fact that you can or cannot learn in different ways. I'm an educator. There's a lot of different ways. Everybody's a little bit different. People learn in different ways. I'm not here to say there's one way or the other. There's a lot of different paths. What I am here to suggest is with tackle trading, you can get on a single path. You can work with a coach, a community, all like-minded, all trained on the same systems, the same rules, and we all help each other out. And that's what tackle trading can provide, is the right roadmap with the right team to help you achieve your goals in the simplest way possible. That's what tackle trading can do. That's why we created tackle trading. That's why we have all of our programs for tackle trading. That's why we have our pro membership for tackle trading, is so that we can do this together. And so if you want to be a part of that awesome community called tackle trading, you can do so very, very easily just by going to tackletrain.com and signing up for a 15-day free trial. And you can get access to all of the content for the pros, for the pro membership, weekly reports, mastermind groups, coaches shows, cash flow clubs, you name it. We do a lot for our community. We put out a lot of content. We put out so much content, you are not expected to read it all. You are not expected to view it all. You are not expected to attend it all. At no point will any coach be like, "Ooh, I'm going to criticize you for not going to the coaches show." No, we do a lot for our community. You can go and take whatever you want at your own time frame. And if you want to be a part of that, you can do so for free. 15-day free trial, 97 a month. After that, it pays for itself. Simply, you go pop a couple trades, hit a couple trades, guys. Go hit that arm trade, paid for a year of tackle trading. Do this the right way. And if you have other educational needs and you want to learn specific systems, whether it's cash flowing with covered calls in the Tackle 25, or learning how to day trade with the Day Trade Mastermind group, or learning how to swing trade with the step system, or learning how to do bull puts, bear calls, and iron condors with cash flow condors, learning a lot of different ways to generate cash flow or make money in the financial markets. We got a lot of different systems. Sit down with Coach Sylvia. Make some decisions over what's best for you. No difficulty. If you say, "I just want to focus on the pro membership," that's fine. It's fantastic. Come join. You'll love it. The water's warm. It's fantastic. You want to get a coach and work one-on-one with myself or Coach Mark or Coach Gino? Talk to Sylvia. You want to work on a specific system and master swing trading? Well, if you want to master swing trading, I would master day trading in the step system. You want to master cash flow? I'd master the Tackle 25 and cash flow condors. You want to learn how to protect your asset classes in case the end of the world occurs? Well, learn how to buy put options with Bear Market Survival Guide and work one-on-one with a coach who knows how to help you apply it on a day in, day out basis. That's what Tackle can do. And so if you're interested in that, let's just go sign up for a free trial, get yourself a consultation, sit down with Coach Sylvia, and see what's right for you. And it's going to be as simple as that, ladies and gentlemen. And with that said, I hope you enjoyed tonight. I hope you enjoyed the training here tonight. Tackle Trading is, by the way, Tackle Trading is the #1 rated financial education company on Trustpilot, a third-party survey review. We don't generate our own. And so if you want to join that amazing community, again, I already talked about all of that. With that said, guys, I am out for tonight. I'm going to go make myself some dinner and enjoy the rest of my evening, but I hope you guys enjoyed here tonight. Tackle Trading appreciates you. And if you need anything from us, let us know.